66,329. That is the historic number the Nikkei reached, breaking into completely unprecedented territory on Friday, May 29th, Japan Standard Time. Hello, everyone. Welcome back to AI Market News. Today, we're looking at a market landscape defined by historic highs and shifting macroeconomic currents. We're going to explore the forces driving Tokyo equities to these record levels, examine the persistent strength of the US dollar against the yen, and prepare all of us for a massive mega event that could completely reshape global market liquidity in the coming weeks. Now, as we can see in the chart, the Japanese market achieved a massive breakout. The index surged 1,636 points, that's roughly 2.5%, to close above the 66,000 level for the very first time in history. Based on available data, this remarkable rally was driven heavily by renewed semiconductor enthusiasm, with major names like Fast Retailing and SoftBank pulling the broader market upward in a really sustained momentum trade. So why is this happening? To understand this breakout, we really have to look at the interconnected nature of global semiconductor supply chains. The initial catalyst actually originated on Wall Street, where the Philadelphia Semiconductor Index surged 5.5% following aggressively raised price targets for Micron technology. Because global AI infrastructure demands require immense coordination, capital flows directly into critical Japanese suppliers like Tokyo Electron, Advantest, and Kioxia. They provide the essential hardware for these technologies, making Tokyo a direct beneficiary of US tech spending. On top of that, global risk appetite got a nice boost during the New York session from reports of a US-Iran ceasefire extension. Transitioning over to the US equities picture, the graph shows a really stark market bifurcation. We're seeing a clear split between the record-setting tech-heavy Nasdaq and the relatively flat Dow Jones. The mechanism behind this split is pretty straightforward. Corporate capital spending on artificial intelligence remains incredibly robust, lifting software and tech giants to new highs, while traditional industrial demand remains murky. Investors are essentially concentrating their capital in sectors demonstrating clear, immediate growth. That leaves the more cyclical industrial and manufacturing stocks that make up the Dow trailing behind. While the technology sector continues to surge, we need to shift our focus to some broader macroeconomic threats. Let's dive into understanding new stagflation signals. We're starting to see new stagflation signals emerge in the latest economic data releases. This dynamic is incredibly challenging for policymakers. It happens when economic growth slows down but inflation stays stubbornly high. For instance, first quarter US GDP completely missed expectations, coming in at a sluggish 1.6% annualized growth. Meanwhile, the PCE price index, which is the Federal Reserve's preferred inflation gauge, held at an elevated 4.5%. This combination absolutely corners central banks. Cutting interest rates to spur economic growth could easily worsen inflation, while hiking rates to fight inflation could severely damage an already slowing economy. Because of this tricky dynamic, markets are now pricing in a 50% probability of a rate hike by December, marking a sharp reversal from the rate cut narratives we saw earlier this year. Directing our attention to currencies, as we can see in the chart, the USDJPY, dollar-yen, pair remains highly sensitive. It's hovering near the critical 159 level, while US 10-year Treasury yields retreated slightly to 4.45%. This movement is driven almost entirely by the yield differential between the United States and Japan. Here's how it works. When US Treasury yields stay elevated, they naturally attract global capital seeking better, safer returns. This constant outflow of capital generally weakens the Japanese yen against the US dollar, and it's a trend that will likely persist as long as US inflation data keeps the Federal Reserve from lowering interest rates. Pivoting to corporate news, a colossal event is about to reshape market liquidity for all of us in the coming weeks. That brings us to our next focus, the mega event, the SpaceX IPO. According to current market information, the SpaceX IPO roadshow is officially starting on June 4th. The company is targeting a staggering valuation of between $1.75 and $2 trillion, seeking to raise up to $75 billion in capital. To put that into perspective, this would comfortably surpass Saudi Aramco as the largest listing in recorded history. The offering is anchored by its highly profitable Starlink segment, which now boasts over 10 million subscribers. What is absolutely crucial to understand here is the liquidity drain effect. A mega IPO of this unprecedented scale literally forces institutional and retail investors to sell their other holdings to free up cash. This capital rotation can create broad downward pressure on secondary markets and smaller tech names, simply because vast amounts of capital are being completely absorbed by the newly issued shares.
Before we close out today, let's review the economic calendar for upcoming key indicators in Japan Standard Time, which will heavily dictate market direction. We have the ISM Manufacturing and Services PMIs, JOLTS job openings, and ADP employment data trickling in throughout the week. However, the most critical event for all of us is Friday's May non-farm payrolls, Hinnogyo Mokobomon Goyojasu. The key mechanism to watch here is that a strong jobs number indicates a resilient U.S. economy, which typically means the Federal Reserve will keep interest rates higher for longer. This scenario generally strengthens the U.S. dollar against the yen and puts pressure on risk assets. Conversely, a weak jobs number could revive rate cut bets. So, as we face looming stagflation fears and a massive liquidity drain from SpaceX, the big question remains, will global tech momentum be enough to carry the Nikkei to 70,000, or are we standing on the precipice of a major market correction?
Thanks for watching. Please subscribe and hit the like button.
This video was automatically generated by NotebookLM. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.